Hi and Assalamualaikum. My name is Nohayati binti Imran. I'm from course BA242 from the group class JBA2423A. I want to make a video presentation about the capital structure for my course FIN544.
What is capital structure?
What is capital structure? Generally, capital structure is a combination of debt and equity that support a business to finance their operation and asset, and also can be used to fund the operation. In order to support the business, the company need a fund, model, or maybe a capital as their financial source, which is by getting a debt source or maybe an equity source.
How to determining optimal course?
The proportion mixture of debt and equity to determine the optimal capital structure can be done through the WACC. The lowest WACC of capital resulting in maximizing value of company's shareholder wealth. The WACC can be calculated as follows, where D is a total debt, E is total equity, KD is cost of debt, KE cost of equity, and T interest rate.
Discuss the factors affecting capital structure and capital decision.
There are several factors that affect capital structure as follows. The first factor is the company must know their position of cash flow. Based on the composition in the statement of cash flow, the company must know whether they have the ability to generate enough cash flow in the future. If the company is already have a legal obligation, for example, paying a fixed rates of debenture, interest loan, dividend, preference share, and the others, while the expected cash inflow is less than cash outflow due to the obligation of making payment, it might turn the company to insolvency. Next is creditworthiness. It's situation where how the company as borrower are worth to receive the new credit. The company with a good reputation on their creditworthiness can easily raise a fund with less interest and also less term condition. Creditworthiness also give them to pay their loan on time. Besides, the tax policy also can affect the total debt of the company. If the government put a policy that require them to pay the tax in higher rate, so it must pay also the higher corporate tax, or maybe they may incur the high dividend and capital gains. It will cause the discouragement of equity by investor and influence a debt instrument that might be incurred by a company. Fourth is the size of company. The size of company, example, for a big company, they tend easily in raising a long-term loan. In addition, they have to pay the rate of interest at lower price, and the requirement they need also not affecting to roll their business because they have their own brand and also established profit. So it's not a big deal for them since they have a wide range of capitalization. Reverse condition for a small company. Lastly, life cycle. If the company reach at maturity stage, the product and the service of the business are already established and need to expand. Therefore, a company will need a fund to raise their business. For example, fund that arise from the ordinary share for the company capitalization. Unlike the business at early stage, the risk of failure is high when they do a capital structuring.
Discuss about financial distress.
Financial distress is the situation where the company are suffering to pay the obligation. It is due to the company might have sufficient in their revenue. It is due to factors such as having a high illiquidity asset, facing a high debt, incur many bill expenses, and the others. If the company is on the side of financial distress, it will lead the company bankruptcy. When the financial distress happens, the company must be concerned and took the action as soon as possible, not to worsen the situation.
Discuss the integration of tax effects and financial cost distress.
In the integration of tax effect and financial cost distress, there is trade-off between the tax advantage of debt and also the cost of financial distress, so it resulting in difficulty with the price and rigorous formula. Even the Modigliani and Miller argue with each other that the presence of tax will arise the firm in value and leverage. Therefore, integration of tax effect and financial cost distress are delivered by the figure 1.0 below. Based on the figure above, the diagonal straight line represents the value of firm with cost. The integration of debts is small because the present value of a tax shield on debt which minimize the financial cost distress. So every increase in debt will increase the present value of this cost. So it will equally increase to a tax shield. So both tax shield and distress cost integrated with each other, which limit to the optimal amount in the debt in the firm's capital structure.
Discuss agency cost of equity.
Agency cost of equity is a conflict that happens between a shareholder and also the management of the company. It arises due to the factor from the company management that make a decision which not give the best interest and benefit to the shareholders. Therefore, it will decrease the value of the share as been viewed by the shareholders.
Discuss packing order theory.
The pecking order theory is a method of financing where a company can prefer to finance their business through the following sequence, which is first by retained earnings, debt and also equity. This pecking order theory also can relate with the asymmetric information, which influence a business decision to choose a method financing. It states that a company should prefer to finance itself first internally through a retained earning. If this source of financing is unavailable, the company should then finance itself through a debt. Finally, as a last resort, the company should finance itself through the issuing of new equity.
Discuss signaling hypothesis.
Signaling hypothesis is a situation where a manager and the shareholder share the same information. It was also known as a systematic information. It means that they might be agreed the decision that had been made together, which is between manager and the shareholder. However, it's believed that the manager will have the inside information better than the shareholder, as they been discussed in pecking theory.
Conclusion.
From this overview report, there is no significant that a pecking theory, signaling hypothesis, agency cost of equity that can lead into an optional capital structure. It depends on the factor of business itself, such as position cash flow, company size and other factors, whether they will get their source of financing either in internal financing or external financing.